What if the biggest threat to your gold and silver investments isn't the market, but the tax rules changing behind the scenes? Today, we're facing a period of rapid regulatory shifts that could impact how precious metals are bought, sold, reported, and taxed. Most investors are focused on price movements, inflation, and economic uncertainty, but very few are paying attention to the tax changes that could significantly affect their profits and long-term wealth preservation. The reality is simple. When governments adjust tax policies, investors who are prepared can protect their assets, while those who ignore the warning signs often pay the price later. In times like these, knowledge becomes just as valuable as the gold and silver you hold. In this presentation, we'll examine what these changing tax rules could mean for precious metals investors, why timing matters more than ever, and the practical steps every investor should consider before the next wave of changes arrives. When we talk about the gold and silver tax landscape today, we are not just discussing a simple adjustment in numbers or a routine policy update. We are looking at a shifting framework that directly influences how wealth is preserved, how profits are realized, and how investors position themselves in an increasingly controlled financial environment. Precious metals have always been treated differently compared to traditional financial assets, but what is changing now is the speed, complexity, and global alignment of tax policies that are beginning to converge on one central theme: greater reporting, tighter compliance, and more structured taxation around tangible assets like gold and silver. For decades, many investors operated under relatively stable assumptions. Gold and silver were seen as safe haven assets outside the direct volatility of fiat currencies and less exposed to the kind of aggressive policy interventions we see in equities or derivatives markets. However, that perception of simplicity is gradually being replaced by a more detailed and sometimes more restrictive regulatory environment. Governments across different jurisdictions are increasingly recognizing that precious metals represent not just a store of value, but also a significant channel of private wealth accumulation that often moves outside conventional financial tracking systems. As a result, tax authorities are beginning to refine how these assets are categorized, how gains are calculated, and how transactions are monitored. One of the most important shifts in the current landscape is the way capital gains on gold and silver are being defined and enforced. In many regions, precious metals are no longer treated as neutral stores of value, but as collectible or investment assets subject to specific tax brackets. This means that the moment an investor sells, exchanges, or even in some cases transfers physical metals, a taxable event may be triggered. What complicates this further is the variation between jurisdictions, where one country might apply long-term capital gains rules, while another classifies metals under a higher collectible tax rate, creating an uneven global environment that investors must now navigate with far greater precision than before. At the same time, reporting requirements are becoming more stringent. Transactions that once took place privately or through less formal channels are now increasingly subject to documentation. Dealers are required to maintain more detailed records, and in some cases report transactions directly to tax authorities. This development introduces a new layer of transparency that fundamentally changes the traditional privacy associated with physical gold and silver ownership. Investors who were previously comfortable operating under minimal reporting expectations are now finding themselves in a system where almost every movement of metal can potentially be tracked, recorded, and assessed for tax liability. Another critical dimension of this evolving landscape is the growing integration of digital monitoring systems. Financial oversight is no longer limited to paper records or manual reporting. Instead, we are seeing a shift towards centralized databases and automated compliance tools that connect financial institutions, dealers, and regulatory agencies. This means that the tax treatment of gold and silver is no longer just a matter of end-of-year reporting, but an ongoing process of data collection and analysis. Even small transactions that might have once gone unnoticed are increasingly being captured within larger financial monitoring frameworks, creating a more comprehensive picture of investor activity than ever before. It is also important to understand that these changes are not occurring in isolation. They are part of a broader global trend toward tightening fiscal control and expanding tax bases in response to rising government debt levels and economic instability. When governments face financial pressure, they naturally look for assets that have historically been undertaxed or lightly regulated. Precious metals fall directly into this category because of their portability, intrinsic value, and historical role as a hedge against currency devaluation. As fiat currencies continue to face inflationary pressure, the incentive for governments to more closely regulate gold and silver transactions becomes stronger, not weaker. This evolving environment also changes investor behavior in subtle but important ways. Some investors begin to shift toward longer holding periods to delay taxable events, while others explore alternative structures for storage and ownership in an attempt to optimize tax efficiency. However, as regulations evolve, many of these strategies face increasing scrutiny, which means that what was once considered a flexible approach may no longer provide the same advantages in the future. The key challenge is that tax rules are not static, they adapt in response to market behavior, and as investors adjust, regulatory frameworks often adjust right back in response. Another layer of complexity comes from the classification of different forms of gold and silver. Physical bullion coins, ETFs, and digital representations of metals may all be treated differently under tax law. In some cases, ETFs are taxed as securities, while physical metals are treated as collectibles, each carrying different rates and reporting requirements. This creates a fragmented system where the form in which an investor holds their assets can significantly impact their after-tax returns, even if the underlying value of the asset remains the same. Understanding these distinctions becomes essential for anyone serious about preserving wealth in this sector. We also need to consider the psychological impact of these changes on the investor community. When tax rules become more complex, uncertainty increases, and uncertainty often leads to hesitation or reactive decision-making. Some investors may delay transactions, others may exit positions prematurely, and some may avoid entering the market altogether due to perceived regulatory risk. This behavioral shift can influence market liquidity and sentiment, adding another layer of indirect impact that goes beyond the tax rules themselves. In addition, cross-border considerations are becoming increasingly relevant. Investors who hold gold and silver across different countries or who engage in international transactions must now deal with a growing network of reporting standards and tax treaties. Information sharing between tax authorities is expanding, meaning that discrepancies in reporting can be identified more easily than in the past. This reduces the effectiveness of traditional arbitrage strategies based purely on jurisdictional differences and forces investors to take a more globally consistent approach to compliance and planning. As we move deeper into this evolving system, it becomes clear that the new gold and silver tax landscape is not simply about paying more or less tax. It is about adapting to a structure where transparency, documentation, and regulatory awareness are becoming central to investment strategy. The old model of passive ownership is gradually being replaced by an active requirement to understand the legal and fiscal environment surrounding every transaction. And as this framework continues to develop, the interaction between monetary policy, fiscal pressure, and precious metals taxation becomes even more interconnected when we examine why governments are increasing their focus on precious metals. We have to move beyond the surface level explanation of taxation and look deeper into the structural pressures that are shaping modern financial systems. Gold and silver are not just commodities in the traditional sense. They represent a parallel store of value that exists outside the direct control of fiat currency mechanisms. This independence is exactly what makes them attractive to investors, but also what makes them increasingly important from a policy and regulatory perspective. One of the primary drivers behind this growing focus is the global rise in sovereign debt. Many governments are operating with historically high debt to GDP ratios, and this creates a long-term pressure to expand tax bases and improve revenue collection efficiency. In such an environment, assets that are widely held but not fully integrated into reporting systems naturally come under increased scrutiny. Precious metals, due to their physical nature and historical use as a private store of wealth, fall directly into this category. Unlike bank deposits or publicly traded securities, physical gold and silver can exist outside immediate financial surveillance systems, which makes them a target for improved oversight from a fiscal standpoint. At the same time, inflationary cycles have reintroduced gold and silver into mainstream investment conversations. When inflation rises, fiat currency loses purchasing power, and investors naturally shift toward tangible assets. This increase in demand strengthens the importance of precious metals within the broader financial ecosystem. Governments and central authorities are well aware of this behavioral shift. As more capital flows into gold and silver during uncertain economic periods, the overall size of the market expands, which also increases the potential tax revenue associated with transactions involving these assets. In simple terms, as more people turn to precious metals for protection, the fiscal significance of those metals increases as well. Another important factor is the evolving relationship between monetary policy and financial stability. Central banks around the world have spent decades managing liquidity through interest rate adjustments, quantitative easing, and other forms of monetary intervention. However, the effectiveness of these tools depends heavily on the behavior of investors within the system. Gold and silver often act as counterbalances to fiat-driven monetary expansion, serving as hedges against currency devaluation and systemic risk. Because of this, policymakers are increasingly aware that movements in precious metals prices can signal underlying weaknesses in the financial system. As a result, monitoring and regulating these markets becomes not just a fiscal concern, but also a macroeconomic priority. We also need to consider the psychological and behavioral dimension of precious metals ownership. Gold and silver are deeply embedded in human financial history, often associated with security, independence, and long-term preservation of wealth. This cultural perception encourages long-term holding behavior, which reduces transaction frequency but increases accumulated value outside traditional financial systems. From a regulatory perspective, this creates a large pool of stored wealth that is not actively contributing to tax flows through frequent realization events. Governments, therefore, have a natural incentive to ensure that when these assets are eventually liquidated or transferred, they are properly accounted for within the tax framework. In addition, the rise of digital financial infrastructure has made it easier for authorities to track and analyze asset movements across multiple categories. Advanced data systems now allow for integration between banking records, brokerage accounts, and in some cases even bullion dealer reporting systems. This interconnected environment reduces the anonymity that previously existed in certain segments of the precious metals market. As transparency increases, governments gain a clearer understanding of how much wealth is held in physical assets, how frequently it changes hands, and what kind of capital gains are being generated. This level of visibility naturally leads to more refined policy targeting. Another key driver is the global push toward financial formalization. Many economies are transitioning toward systems where informal or semi-formal wealth storage methods are being gradually incorporated into regulated frameworks. This includes not only precious metals but also cryptocurrencies and other alternative assets. The objective is not necessarily to eliminate these markets, but to bring them into a structure where they can be measured, taxed, and integrated into national economic planning. In this context, gold and silver are seen as part of a broader category of alternative stores of value that must be accounted for in modern fiscal systems. Geopolitical uncertainty also plays a significant role in increasing government attention on precious metals. During periods of geopolitical tension, trade disruption, or currency instability, demand for gold and silver tends to rise significantly. This creates volatility in global flows of capital as investors move funds across borders and asset classes in search of stability. Governments monitoring these flows become more aware of how quickly wealth can shift out of traditional systems and into physical assets. This awareness often leads to preemptive regulatory adjustments designed to maintain visibility and control over these movements. Another dimension is the increasing sophistication of tax enforcement mechanisms. In earlier decades, tax compliance relied heavily on self-reporting and manual audits. Today, however, enforcement is increasingly data-driven. Algorithms can identify discrepancies, track unusual transaction patterns, and flag potential underreporting across multiple asset classes. As these systems become more advanced, the ability to monitor precious metals transactions improves significantly. This does not necessarily change the underlying tax law immediately, but it does increase the likelihood that existing rules will be enforced more consistently and more comprehensively. We must also consider the role of financial inequality in shaping policy direction. Precious metals are often held as a hedge against systemic risk by individuals who are concerned about currency debasement or long-term financial instability. This means that in many cases, gold and silver ownership is concentrated among individuals who are actively seeking to preserve or protect accumulated wealth. From a policy perspective, this creates a scenario where a significant amount of privately held wealth exists outside the immediate reach of traditional income-based taxation models. As governments seek to address fiscal imbalances, this pool of wealth becomes increasingly relevant. Another contributing factor is the globalization of tax coordination. International agreements and information sharing frameworks between tax authorities have made it more difficult for assets to remain completely outside regulatory visibility. While physical gold and silver can still be stored privately, the act of buying, selling, or transferring these assets often involves intermediaries who are subject to reporting requirements. As these global systems become more interconnected, the ability to track cross-border movement of wealth increases, further encouraging governments to formalize their approach to precious metals taxation. We also see a gradual shift in how precious metals are being integrated into financial reporting standards. In some jurisdictions, they are increasingly treated similarly to financial securities, with clearer guidelines on valuation, reporting thresholds, and taxable events. This standardization helps reduce ambiguity for regulators, but also increases compliance responsibilities for investors. The more standardized the system becomes, the more difficult it is for transactions to occur outside formal reporting channels. Another subtle but important factor is the role of market transparency in stabilizing financial systems. Governments often argue that increased oversight of asset classes like gold and silver contributes to greater market stability by reducing illicit activity and improving data accuracy. Whether or not one agrees with this perspective, it is clear that transparency initiatives are becoming a central theme in financial regulation globally. Precious metals, due to their historical association with private wealth storage, are naturally included in this push toward visibility. Finally, the increasing focus on gold and silver reflects a broader transformation in how modern economies define and manage wealth. We are moving toward a system where nearly all forms of value storage are expected to be quantifiable, reportable, and integrated into national economic data structures. When we then examine the intersection of taxation policy, investor behavior, and long-term wealth preservation strategies in this evolving environment,